Well guys, finally some green. The bulls got some respite from the selling, but the question now remains, will the rally continue? Or is this just a dead cat bounce? Because when you dive under the hood and remove Tesla and Nvidia from the index, the S&P 500 would have actually been red today. But that's not how markets work. Tesla and Nvidia are in the index, and we need to take all information as it is, not as we wish it to be. So on today's show, we'll be answering the question, was this a dead cat bounce? And should you step into stocks right here? If yes, what should you buy? And if no, how low do we go? Especially since Trump's trade war continues to escalate with Canada and the ever-ominous looming government shutdown is right around the corner. A gap funding bill needs to pass the House by Friday, otherwise further uncertainty gets added to the fold. So where do we go from here? And is this the end? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US tech stocks led a cautious stock rebound on Wednesday as investors focused on the latest tariff news as well as cooler than expected inflation data. And honestly, it was a very mixed day, but we did see some outperformance in the mega caps. Look at AVGO was up 2% along with Nvidia up 6.42%, a very strong rebound. Apple on the hardware side was only down 1.75%. We're going to talk about why Apple fell in light of all of the mega caps rallying. Google, Microsoft, and Meta really held it up for technology services as well as software, but software as a whole was probably the best performing sector inside tech. We saw a big rebound in even the smaller names, Adobe, Netflix, Salesforce, Oracle was up 4% as well. It was completely mixed price action in finance. Amazon was up 1%. Tesla gained a very solid 7.59% on the back of yesterday's 3% day, but there was also quite a lot of red. Healthcare stocks took it on the chin. Same with consumer staples, consumer non-durables, health services, communications. It was a very mixed day across the board. There were winners, there were losers. Such goes the market. Breaking it down into sectors, the S&P 500 gained 0.61% today. A very strong day, relatively speaking, but coming off what has been a pretty disaster March so far. The gains were led by tech and discretionary, up 0.62 and 1.65%. Communication services and energy were also green, same with financials and industrials. And there was a number of red sectors, mostly defensive sectors, utilities, real estate, financial staples, and then materials as well. Materials are cyclical, but the majority of defensive sectors were in the red today. That is kind of good for those that are bullish. So the market definitely positioning risk on, but there is still a little bit of concern. Look at gold up 0.44%. And a lot of the selling was also led by the smaller cap names and mid cap names, particularly in the value space. Small cap value, mid cap value were all very much in the red today. In fact, large cap value posting its worst performance of the week, and large cap value stocks tend to be stuff like real estate, healthcare, utilities, staples. Those names tend to be in the value segments, and that is why we actually saw underperformance by these names. However, large cap core, large cap blend, large cap growth, and growth as a whole performed very well, relatively speaking. So definitely risk on, with the best performing segment here being large cap growth, 2%, completely wiping the floor with every other size and factor segment. And the reason why we saw this today had to do with the inflation report. Inflation came in a lot cooler than expected. Let's actually just look at the headline figures. Month over month, we reported 0.2. The consensus was for 0.3. Last month's inflation print was for 0.5. This is just the CPI. And then year over year, that meant inflation decelerated to 2.8% year over year growth versus the consensus of 2.9% and 3% last month. So a very cool inflation print, a very welcomed inflation print, particularly with everything that's going on in the economy. This is very much welcome. And we saw very much the same in the core component of the market, 3.1% versus the 3.2 expectation, down from 3.3% last month, and a 0.2% month over month print. What also really helped this print was shelter costs. Shelter costs actually rose 4.2% on the year, but the consensus estimate was for 4.4%. So the shelter decelerated, and as a result, inflation and core inflation decelerated as well. However, it was a very mixed day because there was still a lot of tariff uncertainty. Canada announced retaliatory tariffs on nearly $30 billion worth of US imports. The Canadian government says it will follow a dollar-by-dollar approach and institute 25% tariffs on US imports. So the trade war is well underway. It looks like it's just between the US and Canada. We'll see if China pitches in, but $30 billion worth of imports, it might not be a lot for the US, but it certainly is a lot for Canada given the size of its economy. Some other news that also did support stocks today. The House passed a funding bill on Friday to potentially avoid a government shutdown. This has to go to the Senate, and I believe the Senate needs 6 Democrats to vote yes on this bill, assuming all Republicans in the Senate go ahead and vote for it too. There was only one Republican that opposed this bill, and it was Thomas Massey in the House. Nonetheless, it goes to the Senate, I believe, either today or tomorrow for the House vote. Now, this bill had quite a number of stuff in them. It extended the funding duration through September 2025, and there were increases in defense, non-defense, the WIC program, core government services, ICE funding increases, federal wildland firefighters increase, air traffic control increases. There was a ton of budget increases, not a lot of cuts. There were a couple of earmarks here and there, but all in all, the government is looking to spend more through September if this goes ahead and passes the House. I don't know what is going to come from it, but that did help the market to a degree. In terms of individual stock and market movers, Apple was down 1.77% when the broader mega caps were actually up in a very big way. And this is because Morgan Stanley slashed their price target on Apple stock. Previously, they had a price target of $272. They slashed it to $252 on the back of concerns that Siri delays will impact the iPhone upgrade cycle through 2025 and 2026, according to Woodring. Roughly 50% of iPhone users who didn't upgrade to the iPhone 16 said they held on to their older iPhones due to Apple intelligence delay. So this iPhone upgrade cycle was supposed to happen in 2024. Morgan Stanley saying now between 2025 and 2026. We just keep seeing this upgrade cycle for Apple intelligence keep getting delayed a year and year out, and that is why they're cutting their price target, mostly because on the time value of money and what that's going to mean for the overall earnings for Apple. Another big mover was Intel, up 8%. Most of this move coming here in the after hours, and that is because on Wednesday there was a report that the rival semiconductor manufacturer TSMC is in talks with a group of chip makers, including Nvidia, AMD, and Broadcom, to acquire Intel's chip manufacturing business, their foundry business as they call it. According to Reuters, the consortium, which would include Broadcom, would take over Intel's foundry business, which is responsible for building chips for both Intel and third-party contractors. Intel reported a net loss of $18.8 billion. So I think if TSMC goes ahead and turns this around, it'd be very, very good, because Intel was always struggling with the 2-nanometer process. If TSMC was to take over, they could definitely help Intel perfect their 2-nanometer process, and that could really help the supply constraints that stuff like Broadcom, Nvidia, and AMD are struggling with at the moment. Nonetheless, bullish for Intel, but I'm not sure if that's going to be a bullish thing for the other semiconductor names. It means they're going to have to plow a lot of capital into Intel to save a business that is currently losing about $20 billion every single year, guys. And then Adobe reported earnings today, down 1%. Very volatile year in the after hours, probably down about 2 or 3%, because we did see some positive price action here in the day. Now, Adobe beat everything on earnings except RPO, remaining performance obligations. However, they missed guidance for Q1 and the full financial year. However, it seems most of this was priced in. Based on the miss in guidance, you think the stock would be down 10 or 15%, but that is not the. So this could mean that Adobe might be a buy. On my second channel, FinFluential Media, we're going to talk about, is Adobe a buy or is it not? So go ahead, follow me. The second channel will have a video posted about 4 or 5 hours after the airing of this video. Now, looking at breadth, we saw an improvement, 3,600 advances, 2,600 decliners, And we did see net inflows. If you look at it from the lows onward and upward, we did see quite a number of outflows here in the New York Stock Exchange, but we finished the day with inflows into the market. The S&P 500 up about 0.5 percentage point, but market momentum continues to remain sour. We did see an improvement in stuff like the 200-day moving average to 150-day moving average to 100-day moving average, but we didn't really see much of an improvement here in some of these shorter term and medium term averages. So for the market rally to continue, we want to see the 5-day and 20-day retake the 50% mark, and we want to see continued improvement in all of these moving averages, relatively speaking. Now let's hop on the charts. Now, despite all of the upbeat momentum we saw in the S&P 500 and NASDAQ 100, it was still a mixed day across the board. So yes, the NASDAQ 100 up a full percentage point, a very strong rebound, 0.5% for the S&P 500, but the RSP fell. The average stock fell today, as well as mid caps and small caps. They were down 0.1 and 0.47% respectively. So definitely a day for these large cap tech names. You can see here that growth outperformed value, and things looking a little bit sour here in the after hours, but low volume, I get it. Now we continue to see the VIX move lower, volatility tick down, and the spot VIX continues to remain higher than the front month contract, again telling us that this volatility does have an expiration date, and that's exactly what we're seeing on the charts right now. We're seeing a little bit of the volatility subside and somewhat of a bottom being put here in the market. Now yields and the dollar did rise, the 2-year, 10-year, 30-year yield, and this is on the back of the escalation in the tariffs with Canada. As a result, bonds fell, and we did see some pretty solid momentum in Bitcoin, gold, silver. Commodities were pretty good. Bitcoin up ever so slightly, still well below the 100,000 mark it made at the end of the year, at the end of last year. But looking at the S&P 500, very, very interesting, guys. So for those of you that are new here, what we're looking for right now in the S&P 500 is some form of a bottom to be made in this area right here, the 54 to 5,500 area. At around this area, sort of when March OPEX happens. So March OPEX is the 21st of March. All right. So around about that area. Now, I'm not going to say it's going to happen on this date. It might be a couple of days after. It might be a couple of days before. We could actually be bottoming right now. I'm just saying around that date, we could be forming a bottom at this area. Now, it's not to say that this is the exact area. It could be a little bit above. It could be a little bit below, okay? This isn't an exact science. You need to work in ranges, but I'm sort of just giving you the playbook on what to expect. We're looking for a bottom to be put in here and then looking for some form of a tactical bounce. And that tactical bounce could take us to as high as the 57.70 level. Now, when we look at the market as a whole and we look at the major bottom points, particularly in the last year, we see 3 major bottom points. This bottom right here, this bottom right here, and this bottom right here, right here. But the 3 major bottoms are these right here, okay, in comparison to where the market is right now, because we've actually plunged through these bottoms. So you can see that if we are to form a bottom inside this area, we're looking at maybe a higher low or an equal low being put in. That would signal a trend continuation. But for this trend to continue, we would need to go take out all-time highs, and that is asking a lot, especially with the earnings picture and the downward revisions we have seen in earnings. So what we're looking for right now is either an equal low or higher low, and then a move up, and then we'll see where we go next. Nonetheless, it's absolutely imperative for bulls to find support at the 5,400 area, because if they don't, we're going to the next level. That's generally how the market works. But this is where we should find, I think, interim support for tactical bounce in the S&P 500. Looking at the gamma flip zones, and again, if you're new here, this is our gamma flip line, right? It's based on the options market, dealer positioning, and how they hedge their portfolios. And a general rule of thumb to make it simple for you guys, above the gamma flip, we're in positive gamma, and you want to buy dips, sell rips, okay? Looking for bullish momentum to the upside. That is our upside target when we're above the gamma flip. When we're below the gamma flip, right, we're in negative gamma, and dealers generally sell into weakness, buy into strength. You have a lot of volatility, right? And moves can be sharp, but we do aim for the bottom end of the range. That would be the 54.85 area. So right now, what we are still looking for, being in negative gamma, is a move lower into this 54.85 area, particularly into the end of this week. We do know that Fridays tend to be a very ugly day so far in 2024, but that's what we're expecting, and we're looking for some form of a bottom being put in this area that would be an equal low to this low right here. It would be inside our range. If it aligns with the March OPEX, that means we can then go ahead and look for a tactical bounce to the upside, targeting the core resistance. But our first target would obviously be the gamma flip zone. If we can then get into positive gamma, we'd be there target the upside. It's a very similar situation for the NASDAQ 100, although I don't have an exact support zone right here. What I can say though is that this area right here is a great area for us to bounce. The NASDAQ 100 did actually go ahead and rear its head into positive gamma here at the start of the day. However, the bears did come in a very big way. We are in negative gamma right now, and we're still targeting the 19,000 area. Very similar situation with the RTY. We did see quite a lot of volatility. We were in positive gamma, but we are now in negative gamma. So the bears put in the work, got us below, and 1975 is still our overall target zone. But guys, you know the game plan right now. Our overall target for the S&P 500 is this level right here at or around March OPEX. Now guys, looking at the dollar, we are at a very critical level here for the dollar. It's finding a little bit of support, but the second we go ahead, break down below this 103 level, I think we're going to see like a slide to the 100 level. So we're at a very, very key level. And if that slide to 100 does coincide with the March OPEX area, that could provide a little bit of support for the S&P 500 as we go ahead and make that tactical bounce. If the dollar slides, we should also see the 10-year yield slide. Again, putting in a lot stronger form of support here at the 4.1 and 4.3% level. And I do expect much of the same. This isn't surprising. It's actually where we said we're going to find support, but this is where we put in this low. But the second we go ahead, break this level, right, it's probably 4% and lower very quickly in the 10-year yield. But that's probably going to come. But we might need to see probably a de-escalation of tariffs and geopolitical concerns for that to happen, especially right now in the near term. Gold, guys, we were looking for a pullback to the 2,700 area. We do know that Scott Bessent and Trump are looking to revalue gold at about the 2,700 area, looking for a repurchase agreement to add $700 to $800 billion into the treasury and liquid money into the economy. It's going to happen maybe next year, maybe this year, we don't know. But I do think that 2,700 is going to be the floor. So if we do get a pullback to this area right here, we do have a number of very strong support zones as well as resistance zones. And this will be a great zone to probably load up gold for the rest of your life. This will be a long-term bottom if Scott Bessent does the gold revaluation, if that happens. We'll see if it does. Now, guys, individual stock names that I do like right now. You guys know a name I've been buying a lot of lately, Evolution Gaming, EVVTY, that's the ADR. We are looking for a breakout above the $80 area. It's where we had the massive gap right here. We used it as resistance multiple times. We then pulled back. We did actually use it as resistance here, pulled back, but it looks like we're making a rebound right now in Evolution. Evolution was actually up 1.79%, and the stock has fallen based on regulatory concern. However, I think once we break above the $80 area, I think it's onward and upward, and we're going to trade at the $90, $95 area very, very quickly. Guys, the stock I've actually been buying a lot of is PayPal. I'm going to talk about PayPal in FinFluential Media, my second channel. We're going to talk about PayPal right here. At this level right here, PayPal offers about a 17 compounded annual return for the next 5 years. So this is a great spot. And I do think we should see 52-week highs, $94 again before the end of the year. So I'm buying a lot of PayPal, buying a lot of Evolution, buying a lot of value stocks lately. I think they're going to outperform, relatively speaking. And with the weaker dollar, that's going to support PayPal. That's going to support Evolution and the overall business model. Things looking very bright for both these companies. So that's what I'm looking at buying right now. I'm also looking at potentially getting into Nvidia. It was up 6% today, so I may have missed a train in terms of getting in at the bottom. However, very, very bright prospects for this company. You know, we're still looking at growing 52% year over year next year. And if you apply a 30 multiple with that growth rate, right to $5 in earnings per share, you're looking at a stock that should be fairly valued at $150. The stock today is $115. So there is tangible upside to this top end of the range. And this value right here, this 150 mark, would put it back at all-time highs. Just saying. But we're going to talk about all of this in the second channel video. So go ahead, subscribe to the second channel and don't miss the videos. But guys, you know the game plan. We're looking for a bottom in the next couple of weeks at the 54 to 5,500 area. If we do get below here, things look grim. We will then go to the 5,000 area. But in the year and now, this consolidation looks very constructive. We are looking for a tactical bounce that could take us about halfway through this pullback. That could see a 5% move to the upside, and then we'll discuss what will happen next. So I'm bullish right here, but it's going to take some time to pan out, especially considering how quick this move to the downside has been. All in all, guys, if you're a longer term investor, you have a time horizon of 5, 10, 15 years out, this is a great opportunity for you to get long, buy the dip, and don't trip. Now, looking at S&P 500 sector return drivers, we see some very interesting discrepancies. Now, the S&P 500 down 1.9% this year, led by the tech and discretionary sectors, which have been entirely driven by multiple compression. We have actually seen positive earnings growth for both these sectors this year, up 2.6% year to date for tech, up 1.5% for the consumer discretionary space. However, we've seen multiple compression of negative 11.8% and nearly 10% for the tech sector, telling us that tech stocks and discretionary stocks are getting cheaper as the market sells off. They're not getting more expensive. And this is really, really positive for a bounce back. Ultimately, if the earnings picture hangs in there, if we continue to see earnings growth in the index and the multiple continues to compress, we will eventually bounce back and definitely go retake all-time highs. But it all depends on what we are going to do for earnings. Now, the earnings picture is deteriorating when you dive under the hood. The S&P 500 has actually seen a negative 3.7% earnings revision to Q1 EPS. So this is just for Q1, and this is up until March 6th. Now, we've seen downward revisions in pretty much every single sector. However, the main sectors, look at stuff like information technology, only down 0.9%. Look at comm services, down 3.5%, but relatively small when compared to materials, the consumer discretionary space, as well as staples. And these sectors are the most heavily hit by tariffs. And that is why we're seeing a massive downward revisions in these names. And if this continues throughout the entire year, Q2, Q3, Q4, that can impact earnings materially. But so far, it looks like a lot of the earnings hit is going to be in the first 2 quarters. Now, year to date, we have seen a little bit of divergence in the index. Last year's laggards, which were healthcare, value, and materials, are actually this year's winners. This purple is year to date. The blue is 2024. And you can see that they were the biggest losers compared to stuff like growth and technology stocks. Last year, tech, growth, small caps, and large caps completely outperformed. But year to date, they're not doing too well. And that's because the S&P 500 has pulled back. We are seeing a little bit of a defensive rotation, maybe even a value rotation. But based on the overall earnings results we're seeing, I think this should be very short-lived. And if tech, discretionary, and financials continue to grow their earnings throughout 2025, this bounce is going to prove very, very profitable for the bulls. And at the end of the day, guys, this massive pullback we're seeing in stocks is completely normal, despite what you hear on the news. The S&P 500 has actually only pulled back about 8.5% so far this year. The average pullback in the S&P 500 going back to 1980 is 14%, with the average gain being 10.3%. So, guys, when you see something like this, it feels painful because of how great the last 2 years have been. However, it is completely normal when you look at the history of equity markets as well as third year of a bull market. The third year in a bull market tends to be choppy to sideways, but it's around about this time of the year, about 100 days into the year, where we actually see a low put in and actually have very positive momentum into the end of the year. We've tracked the third year of a bull market pretty accurately with significantly higher beta from peak to trough, but that tends to happen because this is just the total of all years. This is just a single year. It's obviously going to have a significantly higher beta, but do expect the market to continue to trade sideways with a lot of volatility until we actually go ahead and get macro certainty. Now, when you look at the Fed's GDP now, they'll tell you that, GDP is looking anywhere from -1% to 2%. However, the New York Fed's nowcast figure pins GDP at 2.67%. That is largely positive, all things considered. Now, this model is heavily based on consumption, whereas the GDP Now model is focused more on exports, imports, and manufacturing. So there is a difference between the two, but we will use both together. Now, we did actually go ahead and get jobs data yesterday, guys. The JOLTS opening came out, and what we saw was actually very positive momentum in the jobs data. Job openings per unemployed worker continues to rise. That's very, very good. And the quits rate actually ticked up. This is voluntary worker quits, and this is actually the average employee feels pretty good about leaving the job and going to find another job. This is actually a positive sign, even though we did see the quits rate tick up ever so slightly. But the biggest concern I'm seeing in the market right now actually has to do with credit spreads. Now, the second credit spreads get above the 100 mark. That's when we start to get worried, but we are starting to see credit spreads, both high yield and investment grade, increase. And I did say that because we haven't seen credit spreads make a move in the last couple of weeks, that there's nothing to be concerned about with this pullback. We are starting to see credit yields rise, and it's something we do need to keep our eyes on, because if we continue this move up, that is the bond market telling you, hey, starting to get worried about growth, the economy, etc. Nothing to be concerned about right now, but just an indicator that we should be, but just an indicator we need to keep an eye on. Looking at earnings for the rest of the week, guys. Now, we did have Adobe today, SentinelOne, UiPath. We're going to cover them in the FinFluential media video. However, tomorrow we get Dollar General, Ulta Beauty, DocuSign, and that's pretty much it for the big names. We also had the CPI data, and following CPI, we get PPI, core and headline figures, as well as initial jobless claims. So we're looking for a 0.3 and 0.4 in the core and headline PPI, and then initial jobless claims, I think anywhere from 220 to 230,000 should bode well. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.